told you, I will also repost the video on my courses. So take a look at that. If you have any more questions, we can go back to that in the next class. Okay. So here, this triangular arbitrage. So in the case of triangular arbitrage, it talks about currency transactions in the stock market to capitalize on discrepancies in the cross exchange rates between currencies. So what we are doing here is that we are comparing the cross exchange rate between two currencies. So as an example, the euro versus the Japanese yen. Two currencies independent of the US dollar. And what we are doing is we are comparing that with the exchange rate using the US dollar as the middleman. Okay. So in this case, whenever we find there are some differences, we have the ability to make some profits, and that is why that is referred to as triangular arbitrage. Okay. Accounting for the bid-ask spread, transactions cost can reduce or even eliminate the from triangular arbitrage. So in the earlier case, we found that we could make a little bit of money, maybe $2,000 more by converting, bringing our money back. But sometimes if you have higher transactions cost, any profits you make might be taken away because of the fees and so on. Okay, so the same thing takes place here also. And in this case, realignment, triangular arbitrage forces the exchange rates back into equilibrium. Okay. So here, strictly what it tells you is that triangular arbitrage is possible when the actual cross-exchange rate between two currencies differs from what it should be, and the appropriate cross rates can be determined given the values of the two currencies with respect to some other currency. So let's look at this example here. Value of the Canadian dollar in US dollars is 0.9. Okay, so this direct exchange rate, if you are in the US, if you want to buy one Canadian dollar, we have to pay 0.9. Now the value of the New Zealand dollar in US dollars is 0.3. New Zealand dollars is 3.02. Okay. So what I'm trying to do here, we are comparing the exchange rate between the Canadian dollar and the New Zealand dollar. Okay. So here, so when you look at the Canadian dollar to the New Zealand dollar, so we can write it as so one is we have the cross exchange rate, that is the Canadian dollar to the New Zealand dollar. And on the right hand side, we have the exchange rate using the US dollar as the middleman. Okay? So what we have here, the the cross exchange rate is 3.02. Okay? That's what it says is, and if you use the US dollar, the Canadian dollar to the US dollar is 0. Okay? And when you look at the US dollar to the New Zealand dollar, that is 1/0.3. So here, what we are saying is that the exchange rate between the Canadian dollar and the New Zealand dollar should be 3, but in the market, the price is 2.02. Okay, so that's it here. So what it means is that, what does it tell you? Is the Canadian dollar overvalued or undervalued when compared to the New Zealand dollar? What does it mean? Is the market price higher than what it should be, or is it lower than what it should be? Higher, isn't it? Because if you are in New Zealand, you pay $3.02 for one Canadian dollar. But on the other hand, based upon the US dollar as the middleman, what we are saying is it should only be worth 3. Okay? So that's why we are saying that the Canadian dollar is overvalued. So definitely here 3.02 is higher than 3, or here the Canadian dollar is overpriced or overvalued with respect to New Zealand dollar. Okay? So that's what we see here. Okay. So how do we make any money out of this? So if you are somebody who has, in currencies, this might give you the opportunity some profits very quickly. Okay. And how do we do that? Can I erase this? Are you okay?
Yeah.
No?
I wrote it.
Okay. It's all set? Okay. So how do we do that? So what we see here is the reason why we call that a triangular arbitrage is because we are talking about 3 currencies, okay? So we have 3 currencies, and that is, it could be in the US, we are talking about the Canadian dollar and the New Zealand dollar, okay? So how do we do that? Okay. So in this case, if you are in the US, the first thing you want to do is you want to buy the currency that is overvalued. Okay. So the currency that is overpriced is the Canadian dollar. Okay. So that's why we want to buy the Canadian dollar, and once you have the Canadian dollar, you want to sell the Canadian dollar to receive the New Zealand dollar. Okay. So in this case, we know that it's worth only 3 New Zealand dollars, but because it is selling for 3.02, you can make some money out of that. Okay. And at the end, we want to sell the New Zealand dollars, and you want to come back to the US dollar. So basically here, we have 3 currencies, and we do a transaction which covers the 3 currencies, and that is the reason why we refer to that as triangular arbitrage. Okay, so here, that's what we see. The appropriate exchange rate would be 1 Canadian dollar is equal to 3 New Zealand dollars, but here you should be able to sell the overvalued currency for the, and in this case, the overvalued currency is the Canadian dollar. Now, how do we do that? Suppose you have $1 million to invest. Okay. So here, if you have suppose you have $1 million US, okay? What you want to do is buy the Canadian dollar, and here $1 million, okay? So that gives you the 1,111,000. That is what you get. And then okay. So here you have 1 million. So this tells you how many New Zealand dollars you get. How much is that? 3 million. So this tells you how many New Zealand dollars you get, And finally, what you're doing is you are buying the US dollar with the New Zealand dollars. Okay? Basically here, you want to buy. Okay? How much do you get here? You end up with 1,667,000. Okay? So here, that's going to be 3,355,558 times 0.3. That should give you 0.00667. Yeah. So what we see here is that you invested $1 million, okay? And the $1 million you bought Canadian dollars. Okay? The exchange rate was 0.9. You ended up with 1,111,111. Okay? And then the Canadian dollars you got, you're going to sell it for the New Zealand dollar. That gives you 3,355,558. And finally, with the 3,355,558, you're going to buy the US dollar. And in this case, you end up with 1,006,667. So basically here, you made a profit of close to $7,000 by doing this. And you can do this, maybe in an hour, maybe in 10 minutes. It depends upon how quickly things come back to normal. Okay? So basically here, that's a quick transaction, and that gives you a pretty good amount of money, isn't it? Close to $7,000 by investing. Why? When it talked about the first description, what we said was it's like sucking up pennies with a giant vacuum cleaner. You are investing a huge amount of money, that is $1 million, making a small amount. A relatively small amount, which is $7,000. But the idea here is that if you can do this consistently, that's going to be a pretty good money. So that is what banks and so on that engage in arbitrage try to do. So basically, they have programs and so on set up to do these trades whenever they see any mispricing. Now, the mispricing could be for 5 minutes, could be for 10 minutes, which means that usually computers do the trades because it's going to be extremely fast. Yeah. I think that's what it's happening. Yeah. Okay. So that's 2 cents. Yeah. That's what you're trying to get. Okay. Yeah. Okay. And this is a little bit easier. The other example, you can go to that. It's a little bit confusing, and the reason why it's a little bit confusing is because you have 2 prices. You have the bid price and you have the ask price. Okay. But in this case, we only have 1 price. Okay, so here, exchange rate of the Japanese yen is 0.011 for US dollar. You got to pay 1.1 cents for 1 Japanese yen. The exchange rate of the euro is 1.4. So for 1 euro, 40 yen. So for 1 euro, you get 140 Japanese yen. And the question is, if you have $1 million to invest, what is your potential profit? Okay. So let's go back to the way we did it. So when you talk about the euro to the yen, so that is given by the euro to US dollar times US dollar to the yen. So that's the way you want to do that when you look at the exchange price. Okay? So when you compare the euro to the yen, that's 140. Okay. And when you look at the right-hand side, what do we have here? The euro to the US dollar is 1.4, and the US dollar to the Japanese yen is 0.01. Yeah? So what do we get here? 127 something? 127, yeah? So what we find is that, okay, the market price is 140, okay? So for 1 euro, getting 140 Japanese yen. Based upon the US dollar, what it tells you is that the rate should be 127. So these are the two numbers, okay? So what does it mean? The euro is overvalued, isn't it? The euro should be trading for 127, but in the market, it is trading for 140. Okay? So that tells you that the euro is overvalued with respect to the Japanese yen, isn't it? So that's what we have. So based upon that, we can, an arbitrage opportunity is there, and we can do a trade, okay? Sorry. So the first step is you always want to buy the currency that is overvalued, okay? So you want to buy the euro because that is overvalued. You want to sell the euro for the Japanese yen, and then you want to buy the US dollar back. Okay? So if you have $1 million to invest, what is your potential profit? Okay? So buy the euro. So that gives you $1 million divided by 1.4. Okay. 714,286, yeah? Okay, so that's what you get. You end up with 714,286 euros, okay? And then you can sell the euro, Japanese yen, okay? So here, when you sell the euro for the Japanese yen, you get 714,286 multiplied by, what was it, 1.4? Yeah? 140, sorry. Times 140. So that gives you, what, 100 million yen? Okay. And once you have the yen, you buy the US dollar back, and here buy the so here the exchange rate is 0.011. That gives you $1,100,000. Okay? So what we find here is that you started with $1 million US dollars and you ended up with 1,100,000. And chances are, this type of mispricing is not going to be there for a long time. So you're able to do this money very quickly. But chances are, it's not going to be such a big difference. So just like you were saying, the difference around 10%, 127 versus 140, you're making that amount of money. Here you are making 10%, more than that, or exactly 10% in this case. And that comes from the mispricing. Okay? Okay, so let's go back. This is quite a difficult question. So I got to finalize the grades for exam 1. If it's bad, I might give you take home for second one, okay? But if it's an in-class, I will only give you something like what we covered, okay? So, but take home may be a little more difficult. That's what we see here. In this case, you have two prices. You had a bid price and the ask price, okay? And I think it becomes a little more difficult to find out and then do the calculation. Is not very hard, but at least to figure out what should be the exchange rate, it's a little more confusing. Okay? But let's look at this. You can buy a euro for 14 pesos, okay? So if you're in Mexico, you want to buy a euro, you have to pay 14 pesos. The bank will pay you 13 pesos for a euro, okay? So again, if you want to sell the euro and get pesos, that is 13 pesos. So this is the bid price and the ask price. So the ask price is 14 pesos, okay? And the bid price is 13 pesos. You can buy a US dollar for 0.9 euros, okay? And the bank will pay you 0.8 euros for a US dollar. So again, what it tells you is that if you are in Europe, the ask price is 0.9 and the bid price is 0.8. And you can buy a US dollar for 10 pesos and the bank will pay you 9 pesos for a US dollar. So again, we are talking about Mexico, okay? The ask price is 10 and the bid price is 9, okay? Now, how do we do this calculation? Like we talked about before, I don't know whether it's a magic formula, but I think one way you can at least check it out is you could take maybe the middle of the bid-ask spread and see whether it compares, okay? Other than that, I haven't seen any correct way to do this. So we can take the bid-ask spread, okay, the middle of that, and then we can compare the exchange rates, okay? So if you look at the euro to peso, okay, so the ask price is 14, the bid price is 13. So let's say we take the middle of that, that would be 13.5, yeah? Okay. Now the euro to US dollar, what does the exchange rate tell you? It's 0.9 euros and 0.8 euros, okay? So here, what we see here is, so euro to US dollar is 1 over 0.85, isn't it? Okay. Because it tells you that if you are in Europe, you have to pay 0.9 euros, okay? So when you compare the euro to the US dollar, that's going to be 1 over 0.9, yes? And how much is that? Point? 1.18, okay? So that is 1.18. And let's look at the last case. So what is the US dollar to the peso? Again, we can take the middle of that. That gives you 9.5. Yeah. Okay. So what is the answer here? One eight. So this is what we get. Okay. So 11.18, while the market 0.5, that's what we get, yeah? So given that, it tells you that the euro is what price. So what do you do? If you are in the US, you want to buy the euros, okay? And here, I think the main thing you want to be careful about is that if you are in the US, if you want to buy the euro, the exchange rate is you can buy a US dollar for 0.9, okay? And the bank will pay you 0.8 euros for a US dollar, okay? So basically here, if you are going to sell the US dollar and you're going to get euros, basically the price is 0.8, isn't it? That's what it says here, okay? So that's where I think it becomes a little bit confusing. What is the price you are paying and what is the price you are getting? So you want to purchase the euros, you get 800 euros, okay? Pesos, and it tells you that the bank will pay you 13 pesos per euro, okay? So if you have euros to sell, okay, and in pesos, this tells you that is 10,400, okay? And finally, you convert the pesos into US dollar, and in this case, it tells you that you can buy a US dollar for 10 pesos, and the bank will pay you 9 pesos US dollar, okay? You end up with 1,040. And like I told you, I think it's, quite a bit confusing, and the reason being that there are so many prices given to you. Okay? You are given the ask price, you are given the bid price, and so on. So chances are, if it's an in-class exam, there's not going to be there some of this. It's going to be only one exchange rate. Okay? You don't have to worry about multiple exchange. Okay. Let me see if I can pull up one more example, and then we can stop that. I don't know, we can try this. This was like a sample problem for exam. Okay? So Hewitt Bank quotes a value for the Japanese yen of 0.007 and a value for the Canadian dollar of 0.821. Okay? The cross exchange rate quoted by the bank for the Canadian dollar is 118 yen for 1 Canadian dollar. You have $5,000 to conduct triangular arbitrage. How much we have conduct? You want to give it a shot? See whether you can do this, and then I can go through that. So the first thing is you want to see what should be the exchange rate, okay? And you want to compare that with the market exchange. Your answer? Bigger? Big? Okay, so let's look at the exchange rates, okay? Of 0.007, okay? The Canadian dollar, so that is 118, okay? So the market exchange rate is 1 Canadian dollar is equal to 118 Japanese yen. Yeah, that's what it says here. And if you look at the Canadian dollar to US dollar times US to yen, okay. So that is equal to 0.821, okay? So that gives you, what is it? 117.28. 17.85, okay, so that's what you get. Okay, so what we see is that the Canadian dollar is a little bit overvalued when compared with the Japanese. Not a big difference, but a bit like a maybe less than that. So here, so you always want to buy the currency that is overvalued, sell it for the other one, and then buy the US dollar, okay? So that's what we will do here if you want to profit from the triangular arbitrage, okay? So here, how much? $5,000? Okay, so here, $6,090.13. Okay. So this is the amount of Canadian dollars you get. Okay. Canadian dollar for yen. So that gives you 6,090.13 times, what is that? 118. Yeah? 118. So how much do you get?
718,635.
718,635. Okay, so that. Then you want to buy the US dollar. Okay. And if with what you get here is 718,635.81 times what is it is how much? 007. Okay. So what do you end up with? 5030.45. Okay. So you invested $5,000, you end up with 5,030.45. Okay. So if it's 50,000, it's going to be $300. If it's going to be 500,000, it's going to be 3,000. Okay. So if you have $1 million, that's $6,000. How much is that? 0.6%. Okay. So if you can do it in 10 minutes or so, that's a pretty good amount of money. And as you can see here, the difference is very small, less than 1 year. but still you might be able to make some money. The only problem is that, especially in this case, if you have a bid-ask spread, chances are you may not make any money, okay? Because you buy at the higher price, and if you sell at the lower price, there is a very good chance you might not make any profits, okay? So, as far as we are concerned, I think in this class we talked about arbitrage, okay? We talked about the definition of arbitrage, and in the case of an arbitrage, basically there are three things, and the three things are you have no risk, you have no investment, at the same time you have positive profits. We talked about three types of arbitrage. The first was we talked about locational arbitrage, and in the case of locational arbitrage, basically what we are saying is that sometimes there could be some mispricing based upon the quotes given by two banks. So there, how can we profit? We can profit if the ask price of the first bank is lower than the bid price of the second bank. The second type of arbitrage we talked about was the covered interest arbitrage. In the case of covered interest arbitrage, basically what we said was it talks about the relationship between today's exchange rate and the forward exchange rate. And there, what we said was the forward exchange rate is like the future value of today's exchange rate. And to find the future value, you want to look at the difference in the interest rates in the US foreign country. So again, if there is forward contract overpriced, you have an opportunity to make money, and as far as the textbook is concerned, referred to as the covered interest arbitrage. But we also said that whenever the futures contracts are undervalued, you might still be able to make money, so that could be somebody in the foreign country or somebody who owns. And the third example, at least to me, that seems the most difficult, that was the triangular arbitrage. And in the case of the triangular arbitrage, what we said was between two currencies, the exchange rate using the US dollar. And in that case, what we said was we typically have that starts with the US dollar, buy the currency that is overvalued, and then you want to sell the